Hey, ladies and gentlemen, boys and girls, legends and legendettes from around the world. This is Jerremy Alexander Newsome with Real Life Trading, and I hope you're doing absolutely phenomenal. This class is entitled Adjusting the Trade, and it's a very popular topic. It's also a very popular terminology, adjusting the trade, and there's a ton of ways to quote-unquote adjust a trade. This is kind of going into the protective put strategy, how to adjust, what do you need to do, what you should focus on, what you should look for, and that type of thing. And I think I'll go a little bit into depth into that today in this particular section. Now, you might be watching this video from perhaps our website, reallifetraining.com. Maybe you're under articles or day trading. If you want, feel free to hop over to reallifetraining.com. It's chock full of epic, awesome information, and of course it's all free. There's a lot of companies out there who offer free weeks, free days, free months even of cool things, but information is just free on the website in general, and it's pretty fantastic, so hopefully you enjoy it. You also might be over on the YouTube channel. If you are on our YouTube channel, hit the subscribe button. I post about at least 3 videos a week minimum. So if you want to subscribe, feel free to, and I would love to have you as a subscriber on our YouTube channel. So checking out adjusting the trade. What the heck do I mean? Well, this particular video and class isn't specifically about how to get into the trade, right? There's previous classes and information and articles about that. This particular class is about once you get into the trade, what then? And I'm going to use a few examples. SPY is one of them. You can go back and watch all of my YouTube videos and articles and all that jazz, but I've been bullish on SPY for many, many years. And the last few years, specifically the last 2, every time someone's bearish, I'm usually pretty bullish. And that's been playing out pretty interestingly, I guess, as a verb, the last few months, because there's a lot of analysts out there quoting how the market was just going to absolutely free fall up there. And I agreed. I mean, in the sense that I thought the market was going to pull back, right? But in this particular market, the trend is the trend until proven innocent, if you will. And this particular trend is very, very strong. And I've been buying the bounce and preaching buy low, sell high for many, many months. And I agree that at some point the market will have a significant retracement. Maybe the end of 2015, beginning of 2016 potentially, but regardless, I'm interested to see what happens. Okay, so let's go into it. SPY, this is a pretty popular ETF. This is the ETF that tracks the S&P 500, and I have a Fibonacci analysis on here. And as you can understand Fibonacci, if you don't use Fibonacci or you aren't familiar with it, again, I teach it for free under the mastery section on Real Life Trading. So SPY, we have a resistance right there at approximately 208.54. Down here, we got some really good hammer candles. We got a phenomenal one white soldier right off the 200, right off of Fib, right off of the support line. So since then, we've been bullish on the SPY. You can see down here, I have a bull put spread on SPY. And we also had a bear call spread. Bear call spread. If you do both together, that's actually an iron condor. Back on 2/17/15, so today I'm recording this is the 20th of February, unravel that particular spread, and today the SPY, the SPY closed at 2/11/24. So it's a good unravel. Thus far, if SPY continues higher next week, that'll become a very, very profitable unravel. And to get more information on unraveling, you can also type in 2 solid ways to mitigate credit spreads into YouTube, and we'll pop up. Anyway, all right, besides all that cool stuff, looking at the SPY. So let's say you're bullish on a particular trade, and you get into the trade, and your trade enters, and you're bullish, and you're in at 209.50, which is our end of day trigger on SPY. What I often do in a bullish market, like I mentioned, this is a bullish market. In my opinion, it's a bullish bubble, which will pop soon. Maybe not fiercely, but it will have a nice retracement. But a bullish trend and a bullish market is a bullish trend and a bullish market until it's not. And ladies and gentlemen, it takes a very, very long time, usually a year or more, for a primary bullish market to reverse. It takes some time, okay? Hasn't happened. Until it does, I'm going to stay bullish. And so in doing so, stay bullish, I'm going to be using protective puts a lot. And the reason I'm doing that is because it prevents us from getting whipsawed. A whipsaw is when you get into a trade. So let's say you get in bullish right here on 2/13/2015. And the very, very next day, the stock did a little bit of this. Or better yet, maybe let's say today is a good example. You get in bullish at 209.50 and you set your stop way too tight. So you actually set a stop right here at 208.59. Well, today you would have gotten whipsaw. Now, whipsaw is just really a premature stop placement. You're placing your stop too early, too tight, or maybe it's just a random act in the market when it does happen and you get whipsawed. So the stock does something that you don't want it to do, boop, you get stopped out and the trade continues. It's happened to me, or I guess it used to happen to me, tons. And of course, I'm not here to say that I do not lose on trades. I lose on trades often, but I win on them much more and I make much more than I lose. That's the point of trading. So when it comes to a whipsaw, they are going to happen. There's no way, 100% certainty to eradicate them. However, I can definitely teach you how to lessen their impact. And that's by using protective puts. First and foremost, about protective puts. Protective puts are like an insurance policy. So I'll say puts are an insurance policy. An insurance policy to your house or to your car is not made for you to get rich. So if your house, hopefully this never happens, but if your house burns down or gets struck by lightning or a flood happens or something cataclysmic, you're not going to make money off of that catastrophe happening. Your insurance policy is going to protect you from loss. That's what a put does. A put literally gives you the right to sell a stock at a specific price. Those specific prices that it allows you to sell is called the strike price. So a put is an insurance policy, and you can see on SPY, I have a protective put at 208.22. This does not mean that I've purchased the put yet. When I get into a trade, if you ever see I have a trigger and a protective put, this protective put is literally also a trigger. It means that if SPY does something like this, I will then and only then buy a protective put at 208.22 in hopes that SPY does this and continues bullish. That's kind of what I'm hoping. So this is not a stop, it's just a protection. Now, if this does happen, good for you. You bought insurance and you're protected against a loss. And that's what you want to do in trading. Mitigate your losses as much as possible. So in this particular situation on SPY, I have a put at 208.22. When you buy a protective put for insurance, when you buy a put, actually I'll just say when you buy an option, because you can also buy a call for insurance. When you buy an option for insurance, I usually buy at the money or 1 or 2 strikes out of the money. And I buy 4 weeks or less to expiration. So let me explain what that means really quickly. And I will hop over to an options chain to explain this. This is just Yahoo Finance, nothing special, website just like normal. SPY, and I'll type in SPY, and right here on the left-hand side where it says options, I don't know if you guys have ever seen that before, but I'll click on options right there. Boom. There we go. And this is where you can see the expiration date. Here's your expiration dates of your options. And down here are the strike prices. So let's come down and go all the way to the puts. So these are calls and these are puts down here. Come down to the puts. Actually, let me do a different expiration. Let me do March week 2. So March 13th, 2015. And I'm going to scroll down. There we go. So we won't have as many. And again, so I have a put at 208.22. That is the particular price where I will trigger in buying the actual put. So the stock comes down, boom, hits 208.22. I hop into a protective put. What put do I buy? Well, I buy 1 to 2 strike prices out of the money or at the money. In that scenario, 208 would be at the money. 208 would equal at the money because it's right near, the strike is pretty much exactly where the stock is trading. 1 strike price out of the money would be 207, and another strike price out of the money would be 206. So here's the option chain, and right now the 208 put, you could buy it for $1.34. That's how much it would cost you to buy the actual put itself. However, if SPY goes down and it's at the money, so let's say this is at the money, you can notice it'll be about $2.24. So it would go up about $1 in cost, approximately. And this is just on SPY. It does change stock to stock. But again, the option is going to increase in value when you get closer to it. So it's going to cost you money when you buy it. So I'm going to give you an example, a real life example, and hopefully that explains it. But when I buy an option for insurance, I buy at the money, 1 or 2 strike prices out, and I buy 4 weeks or less to expiration. This is the part that will sometimes confuse you, or less. All right. So how long do you anticipate buying the option? Ladies and gentlemen, the truth is there's no right or wrong answer. I usually buy more than a week. So if I guess I had to say this, 4 weeks or less, but usually more than 7 trading days. So I guess I usually buy somewhere between 2 weeks and 4 weeks expiration. Again, which one out of those? I mean, it's going to be dependent on how long you want to be in the trade. If you want to be in the trade a very, very long time, so let's say you want to own those shares until 2027, 12 years from now, then you're going to be buying a much longer option insurance. If you want to be in the stock, a month, if you want to be in the trade 3 months, it depends on how long you plan on being in the trade. And again, there's no right or wrong answer. Just kind of choose a time frame and stick to it, right? So if I'm in SPY, I can assume that SPY would probably move up here in about 2 to 3 weeks. I said 2 to 3 weeks. 2 to 3 months. Does that sound reasonable, ladies and gentlemen? Yeah, it could. I mean, 2 to 3 months, that would bring us into about April-ish, May, and I could expect something like this is possible. How do I know that? Well, that's just, pick a time frame and go with it. So 2 to 3 months is approximately how long I'll be in most trades that, are not day trades, about 2 to 3 months. And if that's the case, then this is how long I'm going to buy the option. Okay, so I think I beat that dead horse. I apologize for my PETA fans out there. Bought the option, protective option. I'm going to be focusing specifically on protective puts on this video. I might do protective calls later, but really that's that's not super often that you're going to get into that situation. All right, perfect. So we've got this situation so far. What I'm going to do now is I'm going to hop into a real life example, and I'm going to show you ticker symbol LUV. This is, not LUV, Delta Airlines. Delta Airlines is a stock that actually hit my protective put and then continued bullish. So just the other day, back here, February around Valentine's Day, I noticed a potential Morningstar reversal off the 100 simple moving average. So let's pull up the 100 simple moving average. And I noticed that on Transportation Thursday, right? On my trading room, I have Transportation Thursday. So every Thursday, we look at transportation stocks. Delta Airlines had a really good Morningstar reversal pattern off the 100. And then we had a gap. Gap action. If you're familiar with my prior videos about gaps, it's a white candle. It gapped up. What type of gap is that? Well, it's a retest gap. Exactly. It's a retest gap. So we're expecting that gap to fill a little bit and then potentially bounce. So when you're doing swing trades, you can use the daily to kind of understand the sentiment, but oftentimes you're going to use the hourly and the 15 to enter your trades. Well, that's exactly what I did. Again, this is hindsight, but at the time, I placed a bullish entry on Delta using this little hammer candle. Now, granted, it actually had not come down and bounced off the moving averages yet, which is really kind of what you want, but it did not do that. Doesn't really matter. I had a bullish entry at 46.41. We got triggered in. Stock came down a little bit farther, and this was my exact setup at the time. I had a protective put in the middle of the gap at 45.72, and I had a stop down at 44.56. So the protective put got triggered this morning when the stock gapped down a little bit, and it triggered at 45.72. So if I plan to be in this trade approximately 2 to 3 months, and the trigger was 45.72, ladies and gentlemen, what option did I buy? And if you're saying that I bought either the 45.50 or the 45 strike price, you would be correct. It's exactly the right answer. I would have bought either the 45.50, which is at the money, or the 45, which is one strike price out. If you wanted to buy the 44.50 or the 44, you definitely could have. It wouldn't be nearly as expensive, but that's just farther out the money. Now, what time frame did I buy? Well, we're in the last week of February. We have 1 week of February left, and that would have been a March week 2 protective put. Because I plan on being in the trade about a month and a half to 2 months, somewhere right around there. So I bought two weeks of expiration on that particular spread. So that put cost insurance costed, I guess, about $1.05. So when I bought the put option, it cost me about $1.05. What that means, ladies and gentlemen, is this. So my trigger to my put, that is your risk. That's your risk on the trade. When you buy insurance, okay, here you go. Risk is difference in trigger and strike price of put. That's the real risk. So if I bought a 45.50, here's 45.50. This is your actual numerical inherent risk. It's the difference between your entry and the strike price of the put that you bought. So when I say trigger, that means wherever you got into the trade. That's your risk. Now, if you think about it, you're spending money on the trade. You're spending insurance, which is about $1.05. So at some point, if Delta moves up $1.05 from 46.41, so let's say that's 47.46, which is exactly where we ended the day, pretty much. That means right now I am breaking even on this trade because I spent $1.05 on insurance. It moved up $1.05 numerically and dollar cost average specification, if that's a word. I am break even so far on Delta Airlines. So my hope is that Delta continues, and if it continues, anything above that price, I'm locking in profit. That is my profit on the potential trade, but I am also mitigated my risk. In case this happens, I do have insurance. Follow me, guys, so far? Okay, great. If you have any questions, feel free to email me anytime, Jerremy at Real Life Trading. I'd be happy to explain it to you a little bit farther. So I'm going to get this off for just a moment, So you have a trigger. This is the risk. The maximum risk is the difference in the trigger and the strike price of the put, technically. I like to calculate risk between the value of the trigger and the value of my triggering my protective put. Because if Delta had done this, the entire time that would have happened, the put option would be going up in value. I'd be making money on the put. I'd be losing money on the stock, but the put would offset my losses of the stock purchase. Okay, so as far as adjusting your trade, what now? Well, truthfully, on Delta, my target is 49.65, ultimately. So if Delta does this, I'll be happy as a clam in water. Are clams really that happy? I don't know if they are. Anyway, I'd be happy. But, here's the but, I still spent money on my insurance. I spent $1.05. So I did not make as much money as I could have on the trade. Granted, that's not a problem in my neck of the woods. Right? I would never go home and complain to my mom or dad, I didn't make as much money as I could have. I would simply say, hey, this was my plan, this is what I did, this is what happened, boom, end of story. Here's where adjusting the trade becomes fun. If you got into this particular trade, right, and you bought the protective put at the trigger, then the stock starts going higher, you have an insurance position which costs you money. That's taking money out of your pocket. What can you do? Well, what you can do is you can come down here below the strike price of the put you bought and sell a put. So what this means is, let's say, for example, that you bought the 45.50 put. So I'm going to go ahead and write that in. Insurance costs about $105. I'll put a dollar sign. Insurance costs about $105 for the 44.50 put. Now the 44.50 put, that's the strike price. This is the strike. It just simply says the cost at which you have the right to sell the stock. So again, if the stock does this, you can turn around and sell it at 44.50, mitigating your risk. So from here, if you wanted to, what one could have done is come in here and said, all right, stock is going in my direction. Beautiful. I will sell to open the 44.50 put. Now, why would anyone do that? Good question. This, ladies and gentlemen, creates a debit spread. This is a debit spread called a bear put spread. A bear put spread is actually a non-directional bearish trade. It means you have a put and you sell a put below the strike price of the put that you bought to bring money in. I'm sorry. I just noticed a mistake. I said 44.50. I meant 45.50. There we go. So that means, let's say hypothetically, that Delta Airlines goes boop and just tanks. This becomes your maximum reward. So let me come over, and I'm going to come right back to Delta, but let me explain this in just 1 second, because I can tell I'm losing a few of you, which is exactly what I want. Sounds crazy, but I want you to learn through this experience. Let me come over to QIHU, which is QIHU 360 Technology. And I have a real-life trader named Jason Chase. He's in this trade bearish, and he's hoping to make some money with puts. I think most of you guys are aware of that, right? Puts, they make money as the stock goes down. So let's say hypothetically that Jason just simply bought a put. I don't know exactly the information of what he bought, but I know he bought a put. I don't know the strike or anything, so I'm going to make a little bit of it up. So I'm going to say he bought a 56 May put. So he bought a 56 May put, meaning the 56 is the strike price of the put. So if QIHU does this, he's going to make money. Do you guys understand that part? Right? Puts go up when stocks go down because a put is the right to sell, and you always want the right to sell for more. So if the stock is at 46 and the put is at 56, that's going to be worth at least $10 in value to somebody, because right now the stock is trading at 46, and if they have the right to sell it at 56, that means that they have a $10 difference in their share price. Make sense? Okay. So Jason Chase has a 56 May put, and there's good volume increasing. It closed below support. It had a nice little gap action right there. It's failing some fib levels. Boom, boom. Good. Looks pretty. So let's say that Jason expects QIHU to trade down to approximately 48.71, pause, do a little bit of this guy, and continue. This guy is called a flag, a bearish flag, as you guys have learned probably in real life trading or somewhere else. It's a little bit of a flag. So let's say he expects that to happen. What could Jason Chase do? Well, during that time that it trades sideways a little bit, Jason could sell a put lower. Sell to open 47 March week 2 put. Sell to open March 47 week 2 put. So I'm going to go down here where it says 47. Now again, ladies and gentlemen, 47 is the strike price of the put that he's selling. What this trade does is it brings money in to his account. So the 56 May put, let's just say it cost $5.70. $5.70. I'm going to make this number green. No, red. I'm going to make this red. No, orange, no red. Red for, that's how much money he spent. He spent $5.70. Okay? When he sells the put lower, when he sells this 47 March week 2 put, he's not going to rob the bank. But he might make approximately 80 cents. Now, this is a guess, just from prior experience. He's going to make some money, but he's going to make about 80 cents, give or take. And what he's expecting QIHU to do is for that time period to do this. Trade sideways. By the second Friday in March, which is March 13th, he wants QIHU to be above 47. So that if this happens, ladies and gentlemen, he is still in his put. He is still making money. But during this little rotation right here, this little flag pattern, he actually got paid 80 cents to be patient. What? Yeah. He made money understanding that a flag pattern might occur, and he brought premium in. It's called a bear put spread. It's a debit spread. Bear put spread. The reason it's a debit spread is because he is still had to spend money on this trade. How much money did he have to spend? Well, initially he spent $5.70. If he made the entire 80 cents, he would subtract that 80 cents from his initial purchase and have a cost basis of his original put, which would equal $4.90. That's his new cost basis, $4.90. I hope I did that math right. I did it in my head. I'm pretty sure I did. Pretty snazzy, huh? All right, well, what happens if this happens? QIHU doesn't pause, fibs are worthless, and the stock just plummets and goes to $34. Oh, no. Okay. What's the worst case scenario? Worst case scenario is Jason makes money in that situation. In fact, he makes almost $10. He makes about $9. His investment was $4.90 after the 80 cents that he brought in. Therefore, his profit is approximately 100% ROI, 100% return on that trade, because his option would be worth about $9, which is the difference between 56 and 47. Is that an aha for anyone? So it's not a bad situation, right? He limited his return. He capped his return. Now, granted, had he held at 34, he'd be up probably, 500-600%. But hey, you never know when that's going to happen. It could not. You never truly know. I'll take the 100% returns all the time and accidentally miss up the 500% return, but you never know when the 500% return is going to happen. Okay, it will happen probably once every 2 years or so. A big, nice move will happen. But you guys get the picture. You understand what I'm saying. This is called a bear put spread, and this is how it works. So the reason that I do this when I'm in a bullish position is to offset the cost, to bring that money in to my account, offsetting my purchase. So let's hop back over to Delta Airlines and explain it one more again. Let's go to the hourly chart this time. So I bought a 44.50 protective put. Let me just make sure this at 44.50. Okay, 44.50 protective put cost me about $1.05. Today, during the trading floor, we went in and talked about this strategy, selling to open the 44.50 put. Now, I know that it's going to be a little bit different right now, but let me just go in and show you after market close how much you could bring in on that put, and that'll be worst case scenario. So this is March sell to open 44 put. Here we go. Insurance costs about this, and this is a March week 2. That's the expiration for the put that I bought. So if I sell the put, what I have to do is I have to do it at this exact same expiration or earlier. I can do earlier because here's what's cool about earlier. Let's say I do a February week 4. Stock does this. I bring in about 20 cents. Then let's say I do a March week 1. Stock does this, and I bring another 20, 25 cents. And then I do another weekly spread, March week 2, and the stock does this, and I bring in another 20 cents each time. So 20 cents, 20 cents, 20 cents. And so that is a 60 cent offset of my $1.05. So that's a possibility that I can do that. I could do multiple weeks, or I could just do one long term, or I could do 2. I mean, it's really up to you. But let's say in this situation, what would I do? A real life trade. Well, if I have March week 2, I would do March week 1. March week 1 and the 44.50 put right now, and this is after what was going on today, would bring me in 44 cents at market. Ladies and gentlemen, as you can see, I've already offset the cost almost entirely. Insurance sold, bringing in 44 cents. March week 1. So here's my expectation. March week 1, Delta Airlines goes a little bit higher. Maybe it's at 48.50 by then. Okay. This March week 1 put option expires worthless, out of the money. I still have this protective put, and I could potentially do it again for March week 2, maybe bringing in, I don't know, 10 cents or 20 cents and offsetting my initial insurance just a little bit more. I could do that. I could go ahead and turn right around and I could just go ahead and do both. So I could do a March week 2 right now. Here's a March week 2. Come down to 44.50 and check this out. I could sell this one right now for 64 cents. There's a bid-ask spread, a pretty healthy one in the middle, so I might be able to get 68, 69, maybe even 70 cents out of that particular spread. So let's just say 70 cents to be generous. So if I sell my insurance, bringing in 70 cents, March week 2, I've now offset my cost of the insurance to only 30 cents. And ladies and gentlemen, well, I guess true mathematicians will yell at me, 35 cents. 35 cents is my risk. That means that numerical value, the stock had to go from here to there. All of this is potential profit. And it kept me in the trade. Interesting. Interesting. All right, so let's flip the script just a little bit. Flip the script. And let's talk about that if it goes down. If Delta does this, okay, you are capped at your protection. Your protection ends here. Sounds like a Stone Cold movie. Your protection ends here. That is your protection. So your 44.50, if the stock starts getting lower and lower and lower than 44.50, you probably need to buy more insurance or exit the position altogether or whatever you need to do because your maximum risk is now capped. So you do have a lower side. So anything below 44.50 is now potential risk. Second thing that you need to know about this particular strategy, and this goes with all debit spreads. If you do different time frames, okay, so here's the two. So let's say I go back to March week 1. Go back to March week 1, and the stock does this, comes down, and on the first Friday of March, which is March the 6th, it closes below 44.50. No. Do not let that happen. Let me repeat that one more time. Do not let that happen. Because if you have a put that on expiration day expires in the money and you sold it, you will be put shares of the stock. So let me repeat myself one more time because a lot of companies don't know this and a lot of companies don't tell you this because they don't trade. Bottom line is if an option expires in the money on expiration date, something will happen to your account. Shares will be bought or sold in some magnitude. And that goes with calls, that goes for puts. It doesn't matter if you bought them or sold them. If an option of any kind, put or call, that you bought or sold expires in the money, something will happen to your account. If you buy a put, okay, so let's move this guy down for right now. Let's say you just simply buy a put. You buy a protective put. Nothing special. You buy stock, you buy a protective put. And on expiration day, which is March 13th, Delta Airlines closes at $44.99. You will, or your broker will go in and they will sell your shares of Delta Airlines at $45.50. Okay, so even a put that you buy or a call that you buy, it does not matter. If it expires on the day of expiration, something will happen to your account if it's in the money. Okay, keep that in mind. So that's the biggest downside to debit spreads. And that really is the only downside, in my opinion. So back to this scenario. All that has to happen for everything to be hunky-dory and fine as wine and all those expressions, all that has to happen is Delta Airlines just has to go up. Doesn't have to go up very far. It just needs to go up. It can hang out up here. Boo, 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 boo. And as long as it closes above 45.50, if this is a March week 2 and this is a March week 1, what will happen if the puts are out of the money? Both options will expire worthless. They will go to option heaven. And now you're just left with your shares of your stock. So let me repeat that. If you buy a protective put and you're in shares and the protective put expires out of the money, you now just simply have your shares of stock. No harm, no foul. That's really what I want to happen on Delta. Almost exactly. I mean, best case scenario, what happens with the Delta, and this is really kind of best case scenario, is this happens. March week 1 comes around. This 45.50 put that I sold expires out of the money, worthless, gone, evaporates, goes to option heaven. I have 1 week left for my put. I do another March week 1 put. Maybe this time I do a 45 March week 1. Okay. I sell another put somewhere over here. Stock goes up a little bit more. Second Friday of March, both options expire worthless. Boom. And now stock comes up to the target. I sell at my target and I've made my profit. That is that. That's best case scenario for this particular trade. I mean, yeah, sure, Delta could keep going higher, but I think you guys get the point. So a protective put is truly there to protect you. Let me do one other example. Let me just do GoPro for a moment. And GoPro was one that I actually got triggered into, and this happened. So GoPro, we had a bullish entry here. So I'm going to get the stop off for just a moment. I had a bullish entry here. So I'll go ahead and put this on the chart for you. Here's the bullish entry, above resistance, all that jazz. Okay, there you go. Format. I'm going to put this on the top. So there was a bullish entry boop, right there, 50.51. And my stop on the trade was below the low of that Marubozu-ish candle, and the stop was approximately 45.59. So this is a trade that you'll see me do often on the trading floor or on a blog or an article or something, is I'll have a trigger, I'll have a protective put, and I'll have a stop. What the heck's the stop for if you have a protective put? Well, if I ever put a stop on the chart, that really means I'm not planning on being in this trade very long. I don't really care about GoPro. I'm not going to be in shares for more than a few weeks to a few months. I'm just going to get out of that trade and all is swell in the world. The stop is for when I exit my long position. Let me say that one more time. The stop is for when I exit my long position. So if I get triggered into an intraday trigger, so it could be a stock purchase, I could buy an option, I could do whatever it is that I'm doing, bullish, okay, I get triggered in at 50.51. The next day, GoPro gaps down, boom, protective put. I get triggered in at 48.43. Ladies and gentlemen, true or false, if I bought a March week 2 48 put, I will be following along with my rules of what type of insurance to buy. And the answer is true. Right? March 48 would be at the money, 43 cents. So it'd be pretty much at the money. So let me kind of zoom in here just a little bit for you guys. So I bought the protective put. The protective put gets triggered. Stock goes, meh, it's free falling, and I get stopped out of my long position. What do I do here? Well, the stop is the long position is for me to say, okay, I'm going to get out of my position. I'm going to exit my calls. I'm going to exit my shares, whatever. So I get out. I take my loss. I realize my loss on my long position. Okay. Now what do I do? It's a good question. I have my protective put. It's a 48 strike price, and it expires in about 3 weeks. That means And since I've already paid for it, I've already shelled out the money, I hope GoPro keeps going down. Because now I'm in just a pure put, nothing else. So what could I do? I could come up here and I could place a stop on my put. That means that just in case something radical happens and GoPro announces that it's going to be filming Real Life Trading's Trading Room live and they get endorsed and everyone freaks out and stock jumps 10 points, I get stopped out of my protective put. I lose on the trade all over. There's just no way to really win on that situation. You lose. And that's going to happen sometimes. Sorry, but it will. Okay? Stock market's not all roses. You're going to lose on some trades. But you definitely would have mitigated your losses. You did not get hosed on the trade. You lost on your initial long. You lost on your protective puts. You lost on the trade, maybe approximately 2R or R1/2, or after commission, maybe a little bit more than 2R, but you mitigated your losses. Okay? However, how many times, ladies and gentlemen, when your stop gets triggered, does the trade continue in the direction of your stop? And I would say a pretty high majority of the time, because we place our stops adequately. So if we have a stop right there and we get stopped out, my guess, my hunch, is that GoPro probably goes a little bit lower. And my target for the put that I've already bought is 42.89. At 42.89, what do I do with the put? I simply exit it. That's all. I just exit. I sell to close my put. I have mitigated my losses. And at that point, since I bought the put right here, and that's traded down to here, this was my risk on the trade. This was the move on the put. I should make a little bit of money on this trade rather than losing. And that is awesome. Now, sure, maybe I break even. Maybe I lose just a little bit. Or maybe I make a little bit. But buying this protective put definitely helped me lose less than I would have had I not used it at all. Right? Had I not used any put at all, I'd be out of the trade. I'd have my loss, and that'd be that. Now, if 42.89 is my target, and I did not expect for GoPro to get to 42.89 by this week, what could I have done? Well, I could have sold a 42 put expiring this week. I would have brought in about 20 cents, creating a debit spread, and would have offset the cost of the put. Let's say that I still do that, and I do that for next week expiration. So I come down here, and I go to GoPro, and I find GoPro, $42 put, no money. At least right now. There's no money in a 42. Okay, fine. There's no money in a 42. What about a 42.50? No real money in a 42.50 either. So what does that mean? Well, it means I probably just won't do it. That means I'll probably more than likely just wait for GoPro to do something. If GoPro trades at the target and I hit the target, boom, I exit and all is well. Now, some of you are saying, well, could you do a March week 1 since you bought March week 2? And the answer is yes. I could do a March week 1. Let's see if there's any premium in a March week 1 at 42. And there's about 12 cents, 26 cents is a spread. Maybe you could get 18 cents on a limit order. Okay. Which isn't bad. 18 cents. 42 is right here. So bottom line is if the stock does this, you are now capped at your maximum reward on this trade. And since you have a March week 2 protective put up here and you sold the March week 1 42 put down there, if GoPro is below 42, which is the put that you sold to create a debit spread, if GoPro is below $42 at expiration on the first Friday of March, you need to close both positions. Well, not necessarily both. But you at least need to close your 42 put that you sold. Otherwise, ladies and gentlemen, if the 42 put that you sold, if GoPro closes below 42 on the day of expiration, you will be put to stock. The only time that that won't happen specifically is if they are the exact same expiration. So if I bought a March week 2 and I sell a March week 2, and then the stock does this, on March 13th, which is the second week in March, so that's March week 2, if I'm down here, the spreads will just cancel themselves out and all will be well. And I'll explain that to you verbally. What would happen is the broker would actually put me shares at 42. But since the protective put that I bought up here at 48 is also in the money, it would turn right around and it would sell those shares at 48. So I would make $6 per contract on the trade. So it's not a horrific deal. Like I said, the Barefoot Spread is not a very scary thing. You can make money on them, right? It's only if they are not on the same expiration dates that you got to make sure your spread, the one that you sell, does not expire in the money on expiration date. So that, ladies and gentlemen, is how to adjust your trade. Let me do this once again. I'll do this with a setup, and let me do this on a trade that I'm in personally, is FEYE, Fire Eye. So on Fire Eye, here's my exact trading plan. My plan was buy the retest. So the stock was trading up, traded down. I bought right about there, and now it's working out, which is good. So notice that I have a protective put at 41.59. That means I do not have a put yet. I have not purchased the put yet. But if Fire Eye does this, I will buy the put. Okay? But then if this happens, boop, and the stock goes up, I will then sell a put lower, offsetting the cost of the protective put that I bought in hopes that Fire Eye keeps going up and I make money, which is the intended overall initial direction on the stock trade anyway. Make sense? Awesome. Good, good, good. I think that kind of clears it up because I do that quite often as far as initializing the debit spread if I need to in a protective option situation. So let me just see if I can find and think of one more trade. Here's Cisco. Cisco is another one that we're bullish in. You can see both the trigger at 29.23, the trigger for the protective put at 28.79, and the stop. The protective put trigger for me is usually the very first place that I would say, all right, I would place a stop here, but it's a really tight one, but this is where I would place it. That's the protective put. The stop is, okay, where has the trade really gone wrong? So if this happens, boop, I buy the protective put. I buy at the money. So in this situation, I'd probably buy 28.50 or 29 or 28.50. I buy at the money or 1 to 2 strike prices out. Then if this happens, I hit the stop. I now exit my long position, and I hope that Cisco continues to go lower. I hit my support line, which I have drawn in. And what do I do here with the put that I bought, ladies and gentlemen? I sell to close. My put, I make a little bit of money on the trade, break even, or lose very, very, very little. Maybe just like commissions. What if I do this on Cisco? Cisco does this, come down, get a wick, I whipsaw, and I start continuing up. Right around here, the green circle, I take that stop, and I change it to a put sale. Put sale lower than the strike I bought. And then I hope that Cisco continues going up. This put sale offsets the cost of this protective put. I'm still in the trade. All is well. Boom, 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 boom. And then the trade comes to my target and I exit. Or I get into a collar. And that, ladies and gentlemen, is a video for another time. I hope this was beneficial. If you have any questions, feel free to post it on this YouTube video. You can also email me anytime at jeremy@reallifetrading.com. You can Facebook us. You can tweet me at Newsome Nuggets. However you need to get a hold of me, I'll be happy to help you, ladies and gentlemen, because I love doing this. This is a passion of mine, and it is a mission of our company to enrich lives. Thank you so much for watching this video. Have a phenomenal day. Feel free to share it with your friends and family or any of the advanced traders that you may know. And until next time, remember, love life, live life, and trade it. I'll see you.